Hi folks, welcome to this video on putting together a balance sheet, or as we call them now under IFRS, statement of financial position. That might be a term that you tend to hear a little more frequently as we move through this course. Now, we have this trial balance for a company at the end of December. And you'll notice in the question, I've just reproduced some of the data here. You'll notice that the data is not given in any particular order, so because you have to do a statement of financial position, you're going to have to go search for the accounts that belong on that statement. Now, you guys again know this statement of financial position is a balance sheet, so why don't we go through and see which ones are in fact balance sheet accounts. Well, I've tried to help you out a little bit there by doing a little bit of highlighting, as you can see, and what you'll notice here as you go through the accounts is anything that's highlighted in yellow, that's actually what I would call a current asset. There's one here you'll see, it's called FV/NI, this little guy here. You'll notice, I'm just bolding it now. That's a fair value through net income investment. And we're going to talk a little bit more about them as we get to other chapters after we complete this one. But you do know those investments. You probably just don't know them by this name. In a previous course, you may have studied those investments that are what we called held for trading. They're largely equity investments, equity meaning share investments, and the company might buy them to trade them on a frequent basis. So those are fair value through net income investments because any gains or losses on those investments are recorded in through net income. Hence the name fair value through net income investment. Now, we record them at fair value, and we'll talk a little bit more about that as we get into the course later. Now, you'll also see that there are some accounts that are in green, highlighted in green, like your bond and these fair value through other comprehensive income or OCI investments. These kinds of accounts are in green because they are considered long-term or non-current assets. Now here's an opportunity to introduce you to the fair value through OCI investment. It's already highlighted for you. And the reason we are looking at that is that kind of an investment is going to be considered a non-current or asset. Why would we consider it non-current? Because those are investments that are purchased by the company and their intention is not to trade them regularly like the fair value through net income investment. Their intention is to hang on to it, maybe likely on a long-term basis, but it might not be like 20 years or anything. They might not know how long they want to hang on to it. So those kinds of investments, if the company chooses that status for them, to the financial statement readers, it tells them that they plan to hang on to it for a longer term and not trade it on an ongoing basis like those fair value through net income investments. And those fair value through OCI investments or other comprehensive income investments get that name because any gains or losses on those types of investments at the end of the period, they're recorded not in net income but through other comprehensive income. And again, we'll talk about that a little bit later. But it is important that you know these fair value through OCI investments are non-current assets, while the fair value through net income investments are current assets. You'll notice we also have some accounts highlighted in purple. Those purple ones are really indicative of current liabilities. And you can see in this case we have a note payable, but the note payable is due in 6 months. So it's due within the next 12-month period or within the current operating cycle. So that makes it a current liability. You'll notice as well that we have here long-term or non-current liabilities. We have a note payable again, but because this one isn't due to be cleared off until 5 years, then that's a long-term or non-current liability. Similarly with the bond liability, it's due in 3 years. So because it's got 3 years to maturity, we're going to include that as a long-term or non-current liability. You also see here that we've got items highlighted in gray, and those are your intangible assets. And you see we're recording them in net of accumulated depreciation, or net of accumulated amortization, I should say, on those intangible assets. That's the franchise and the patents, because that is the normal disclosure practice. Now, you'll also notice here we do have, again, for the long-term assets, some of those little guys highlighted in green, and they also have accumulated depreciation along with them, as well as the building here and land. But with the building, because it's depreciated, you can see we have accumulated depreciation highlighted in there as well. So I'm sure a lot of these accounts you're familiar with, but I think sometimes when you know you have to put together a balance sheet or statement of financial position, you need to be able to identify which accounts are going to go on that statement. Now, the other thing you'll notice here is if you scroll down a little bit further into the data, you'll notice here that you have common shares, retained earnings, and accumulated other comprehensive income. Now, the common shares, retained earnings, and accumulated other comprehensive income are typed in red because these are accounts that are equity, shareholders' equity section accounts. You'll notice two things here. Number one, the retained earnings at $218,000. The reason I've got a star next to that is because in order for you to calculate the balance that you're going to have in the retained earnings account at the end of December, which is when we're doing the balance sheet for, you can see here we've got a December 31st year end. You have to remember that that balance for the retained earnings, that has to be the balance before you've closed. How do I know that? Because in this case, the income statement accounts are still open. You'll see here that we still have accounts available for or open for expenses like admin expenses, interest expense, gain on sale of land. You'll also notice that if you scroll up here, we've got investment income or loss, so anything related to income or loss, cost of goods sold, sales revenue, all of those kinds of accounts, they're income statement accounts, and they haven't yet been closed. So that means your retained earnings isn't yet closed either. Okay, so you need to make sure that you remember to calculate that amount. We're also going to go through a calculation of the accumulated other comprehensive income account that we also showed you is typed in red at the end of this trial balance or this selected data here. And we'll talk about how we calculate that in a moment. Now, in order to produce the statement of financial position, let's now work with our solution. So you can see here we start with a proper three-line title, which looks at the company name, Zhang. We're also looking at the name of the statement, statement of financial position, as well as the date. And don't forget, it's at a date. So now, at this point, let's have a look at the current assets section. You can see we start with the most liquid assets first. There's nothing more liquid than cash. Cash is always going to be your first account. And we have in our question a balance of $205,000, so we'll just put that in from our balances that we were given from the trial balance in the question. You'll notice that we put fair value through net income investments next. Now, some companies, you might see accounts receivable before that, but the reason you don't in most cases is because fair value through net income investments by definition are purchased by the company in order to trade them on a regular basis. So they could be trading these investments on a weekly, semi-weekly, even daily basis. So therefore, we know our receivables, you know, if a customer has 30 or 60 days to pay, they're probably going to take that long to pay. So therefore, we tend to think in our industry that fair value through net income investments will turn over more frequently than even our receivables from any particular customer will. So therefore, we normally would put fair value through net income investments first before accounts receivable. Notice the presentation of the accounts receivable. We always offset the accounts receivable by the amount that's in the allowance for doubtful accounts. You recognize the allowance for doubtful accounts from one of your prerequisite courses for this one as being a contra asset account. Its normal balance is credit. So, because the accounts receivable has a debit balance, we deduct the allowance in order to get our receivables at their net realizable value, and that's $490,000. Then the least liquid of these current assets would be inventory, because inventory technically doesn't turn over for most companies as quickly. So therefore, we're going to take the inventory at the value that we see it at here on the statement, and that's $687,000. So now we're going to total our current assets to get $1.53 million. Now, what we're going to look at next are our non-current assets, but we're going to specifically look first of all at the long-term investments. And we said earlier that the fair value through OCI investments are typically non-current. But now before that, you see that we have bond investments at amortized cost. You'll remember in a prerequisite course, we talked about bond liabilities or bonds payable. And we said that those bonds are issued to investors on a long-term basis. So the bond, when it's issued, is a long-term liability. Now you have to think of the mirror image or the other side of that transaction. The buyer is an investor. So if the bond is a long-term liability for us, whoever bought it, the investor, treats it as a long-term investment. And this bond investment is going to be treated at what we call amortized cost. You remember when we studied bonds payable on the long-term liability side, we did an amortization table using the effective interest method to find out how much interest expense we were going to book in any period. Well, the investor does the same thing, only they're recording it at amortized cost so that they can determine how much interest revenue they're going to book. We'll talk more about bond investments at amortized cost when we get into the investment chapter for this course. But for now, you should understand that a bond investment is a long-term asset and why. Now, when we add those two investments together, we're going to get $644,000. The other type of non-current asset we have is property, plant, and equipment. And we normally put land first. And our land we're given is $260,000 in the question. We look at buildings less accumulated depreciation, as well as equipment less accumulated depreciation. It doesn't matter if you put the equipment before the building, but it is more normal to see land first, although that isn't a must. But in our case, we're putting it first, and we're showing the accumulated depreciation that corresponds to each asset directly underneath it. So accumulated depreciation for the building is right underneath the building account itself. The building is set up at cost, as is the land and the equipment. The accumulated depreciation is deducted from the building account. So this is accumulated depreciation for equipment. This is accumulated depreciation, for building, and this is accumulated depreciation at $60,000 for equipment. So the carrying value of your total property, plant, and equipment is $1,688,000. Now the last type of non-current asset we have here are intangible assets, and you can see these are set up net of the accumulated amortization amounts. So in our case, we add them up and we get total intangible assets at $355,000. So the next thing we do is we're going to look at our total account amount for current assets, which is $1,535,000. We're going to add to it the long-term investment amounts of $644,000, property, plant, and equipment at $1.688 million, and $355,000 for our intangible assets to get a total of $4,222,000 for our total assets. We should find liabilities and equities balanced to the same amount, so we can use this as a check digit. Now, before we move from there, just one thing to remember. You notice here that in the assets section, what we've done is we've divided the assets into current assets and totaled them, but we haven't set up long-term assets and then subdivided. It is a popular formatting not to specify in the assets section a section called non-current assets. The reason being, if it's not a current asset, we know it's non-current. But we do have to specify or break out in the non-current asset area our long-term investments from our PP&E investments and separate from our intangibles. Later on, you'll learn about another asset that goes below intangible assets called goodwill, but we'll leave that for a later chapter. Now we're going to look at liabilities and shareholders' equity. So now what we see here is we see that we now have our current liabilities highlighted just like we did current assets. Now, with the current liabilities, unlike current assets, there isn't anything in either IFRS or accounting standards for private enterprises that specifies the order that the current liabilities go in. So current assets, it was specified order of liquidity. We don't have such a well-stated formatting issue for current liabilities. But we do tend to find that the ones that are most liquid or that turn over most frequently for a company are stated first. But that doesn't have to be the case. We normally find accounts payable would be first. Why? Because we know that we regularly pay our suppliers. Commissions payable would be those commissions that we pay to our salespeople, and probably not until sales are collected would we actually pay them out. So we probably find we don't pay out commissions as often as we pay our suppliers. Notes payable, in this case, again, we know the notes payable were due in 6 months, so they would be the next on the list. And then accrued liabilities are those liabilities that aren't going to be paid till a later date. You remember in your previous courses you would set up adjusting entries for liabilities and expenses, such as a debit to salaries expense and a credit to salaries payable. Well, that salaries payable is an accrued liability. It will be paid at a later date, but you've made an accrual or an adjusting entry for it. Now, in this case, we're going to add up all those accounts, and we're going to add up our current liabilities at $875,000. Now we're going to look at our long-term liabilities, and we can see that these are comprised of our note payable. That note payable we know is due in 5 years, and we know our bond payable is due in 3 years. So when we add them up, we're going to get $1.9 million in total long-term liabilities, which gives us total liabilities of $2,775,000. At this point, we're going to take a break, and we're going to open up another video or start another video to deal with the shareholders' equity calculations.